Now, if you believe in the saying, sell in May and go away, it might prove to be true for the South African market performance as we review the May performance. Now, that says South Africa's benchmark stocks index gained 0.5% in the month of May, recovering from a drop that we witnessed in April. Now, the FTSE JSE Capped Swix index rallied in the last few days of the month, erasing an earlier loss of as much as 6%. But to help us make sense of all these numbers, give us some insight as to some of the standout stocks and sectorial performance, we join on the line by Peter Little, a fund manager at Anchor Capital. Peter, good to have you with us and thanks for making time.
Hey, good. Thanks for having me.
I guess as we get started, Peter, if we do reflect on South Africa's May market performance, I believe it might have left many of us uninspired, demotivated, rather lackluster. But what are your observations of May's performance locally on the markets?
Well, I think as you already alluded to, the market worked pretty hard in the last few days of the month to get to just about positive. So we had some pretty big swings in the last few days. And that was largely just following global sentiment. You had a similar thing offshore where global markets were down pretty heavily till about the 25th of the month. And then we had this kind of sentiment reversal and things really rallied in the last few days. So it was, I guess it prevented a significantly worse month. Certainly the first few weeks didn't feel particularly good, but as South Africans, I guess, certainly our stock market's been, I think it's one of the few that's still in positive territory year to date, if you measure it in dollars or in rands, frankly, and so we can't be too unhappy with that.
Now, we'll take any bit of positivity that we can get, right, Peter, but help us understand where much of this strength might have come from, especially if we take a look at it from a sectorial performance.
So just looking specifically at May, the kind of standout areas, there were two standout areas and they both worked really hard in the last few days of the month. As I said, the local banks had a really good, strong May. They were up sort of on average 5 or 6%. And as did Naspers and Process. They finally delivered a positive month, the pair of them, up also about 5 or 6% for the month. So a lot of the positive performance was coming from there. We had some of the diversified miners that did okay. But those were kind of the things that were dragging us up into positive territory.
Let's talk about where some of the other pressure points might have come from. And I understand MASSMART gave us some disappointing numbers there.
Yeah, they had a trading update. The general retailers didn't do particularly well. They were sort of, as far as the domestically focused companies on our stock exchange, they were some of the laggards. And MASSMART had a trading update that showed sort of year-to-date sales were pretty disappointing. They said they're still struggling to catch up from the impact of the riots that we had in July last year. And then added to that, they said the global supply chain issues are impacting them in terms of getting goods into the country is proving pretty expensive. And so they've got lots of cost pressures coming through there. So their share was down just 10-12% for the month on the back of that news.
Quite concerning there, as you say, a significant fall and a decline that we saw. But if that was the trend for MASSMART specifically, do we find that many of their reasons perhaps continue to ring true for some of the other general retailers following their trading updates and share price performance?
Yeah, I think all of them were pretty soft. I think, MASSMART, I think, was disproportionately hit by the July riots last year, so they're potentially still struggling a bit harder than most on that front. But certainly in terms of import prices, those are going to be impacting everyone in terms of, high food and energy prices starting to crowd out discretionary spending. That's going to be affecting everyone. So those kind of themes are sort of pervasive across the rest of the sector. But yeah, I think MASSMART possibly feeling them the worst.
We can't forget what's been happening with resource stocks, and whilst they've certainly rallied significantly in the last 2 years, what trends did we witness in the month of May?
Yeah, so they were also a bit all over the place in May. The diversified miners are heavily reliant, obviously, on the iron ore price. And I think as there were signs in the last few days of the month that China was getting through the worst of these sort of COVID zero lockdowns that they were subjecting themselves to, and the prospect that to meet their annual economic growth targets, they're going to have to go pretty hard in the rest of the year. And usually the way they achieve that is by huge sort of infrastructure type spending or construction spending, and that's obviously going to be a big boost for the iron ore price. And so I think that sort of as signs that might be coming closer into focus. The diversified miners ran a bit. You're obviously still having all sorts of issues with energy commodities, oil and gas and coal. And so that's benefiting some of the coal exporters, particularly companies like Thungela. So those things were already supportive. On the flip side of that, gold's been pretty weak. So the gold miners were disappointing in May. They were probably one of the worst sectors. And then kind of to exacerbate things, obviously Gold Fields came out with that announcement that it's going to be doing a major acquisition of the gold mine in Canada, and the share price of that was down 30%. But in general, the gold miners were really poor. Gold Fields, obviously the worst of them, but the industrials type diversified miners, or the ones geared towards energy prices, including Sasol, obviously, in the world price, those things were pretty buoyant.
Got you. Interesting to also note that I guess Sasol continued to recover slightly, as we have seen it oscillating significantly. But on that note, Peter, we can reflect on May, but what all investors want to know is, I guess, guidance and key risk factors that we need to be looking out for in the upcoming months. You mentioned the constraints on the global supply chain, which don't appear to be going away. We're well aware that we're seeing rising inflation at the moment. The South African Reserve Bank also responding with a rise in interest rates. What kind of dynamics will this continue to have on the local market performance?
Yeah, so I think you've got two sort of diverging things happening. You've got potentially what's going on in China in terms of them needing to stimulate pretty hard, as we said, in the second half of the year to kind of hit their GDP growth targets, and that'll be good for South African fundamentals as an exporter of industrial commodities. That will benefit us. On the flip side of that, you've got what's happening, obviously, with global inflation and the way that central banks, or the major central banks, are having to respond to that, particularly in the US and more so now recently in Europe with removing liquidity from the system. So removing liquidity from the system is going to be a headwind for markets, for risk assets, for probably the foreseeable future. We expect central banks are going to have to go pretty hard. We don't think there's going to be much clarity on the kind of trajectory of inflation for the next few months. So I think once you start getting into the fourth quarter, you could start to see base effects coming in and inflation pressures easing a bit. I think you'll start to see the impact that the central bank's having on demand start to help with inflationary pressures as well. And global supply chain issues certainly were easing until China locked itself down again, and that's caused another bit of a wobble. But none of the things that are going to kind of give us a clear path on inflation, I don't think are going to happen over the next few months. So I think for the next few months, kind of the market's going to have to be volatile, sort of soaking up bits of data and trying to find a direction based on that. But we think it's going to be hard to find clear direction until there's a clear path lower in inflation, which is unlikely probably to happen until the back end of the year.